The recent changes in interest rates have significant implications for retirement accounts. Interest rates and bond prices have an inverse relationship. When interest rates rise, existing bond prices fall because new bonds are issued at higher yields, making older bonds with lower yields less attractive. This can affect the value of bond holdings in your retirement account. If a significant portion of your retirement portfolio is invested in bonds, especially long-term bonds, you might see a decrease in the value of these holdings. However, if you hold bonds to maturity, you will still receive the face value at the end, plus the interest payments. Higher interest rates can lead to increased market volatility as borrowing costs for companies rise, potentially impacting their profitability. This can lead to fluctuations in stock prices. Your retirement account may experience greater volatility if it is heavily invested in equities. Growth stocks, which are priced based on future earnings, can be particularly affected as higher discount rates reduce the present value of these earnings. Maintain a diversified portfolio that includes a mix of growth and value stocks. Value stocks often perform better in rising interest rate environments as they typically have stronger current earnings compared to growth stocks. Rising interest rates generally benefit savings accounts and certificates of deposit, or CDs, as banks offer higher interest rates to attract deposits. Cash and cash equivalents in your retirement account will likely yield higher returns, providing a more attractive option for conservative investors or for the cash portion of your portfolio. Consider increasing your allocation to cash and short-term CDs to take advantage of higher yields, especially if you are nearing retirement and looking to reduce risk. Real estate investment trusts, or REITs, can be sensitive to interest rate changes because they often rely on borrowing to finance their operations. Higher borrowing costs can squeeze their profit margins. Rising interest rates may negatively affect the performance of REITs in your retirement portfolio. However, REITs that invest in property types with strong demand, such as residential and industrial, may still perform well. Evaluate the types of REITs you hold and consider diversifying across different property sectors. Focus on REITs with strong balance sheets and lower debt levels to mitigate the impact of rising interest rates. With rising interest rates often comes higher inflation expectations. Investments like Treasury Inflation-Protected Securities, or TIPS, can help protect your portfolio against inflation. Including TIPS in your retirement account can provide a hedge against inflation, preserving the purchasing power of your savings. Allocate a portion of your fixed income investments to TIPS or other inflation-protected securities to balance the impact of inflation and interest rate changes. The U.S. Department of the Treasury explains that TIPS are designed to provide protection against inflation, making them a valuable component of a diversified retirement portfolio. Fixed annuities may offer higher payouts as interest rates rise, making them more attractive for retirees seeking guaranteed income. Rising interest rates can lead to higher payout rates for new fixed annuities. However, the value of existing fixed annuities with lower rates may be less competitive. If you are considering purchasing an annuity, compare rates and consider locking in higher rates during a rising interest rate environment. By understanding these effects and adjusting your investment strategy accordingly, you can better manage risks and optimize your retirement savings.